Hey, Jordan Dove here. It's July 21st, 2022, and I'm going to give you the state of the real estate market currently in Southern Nevada. But first, I want to thank you. Thank you so much for supporting my business, my family's business, and because of you, we've been able to grow year over year. We've been able to help hundreds of people, families, service members, and so many more. And I am so grateful for your support. I truly and genuinely believe that real estate is the number one key for generational wealth. It is something that can be passed down to your heirs tax free, without probate, through a trust. So I really believe this is the foundation of wealth. Okay. And as your real estate professional, I want to give you an update on what is going on in our local Southern Nevada real estate market. The market is shifting fast. It's shifting extremely fast. It's actually shifting faster towards a buyer's market than at any point in recorded United States real estate history. And I've had a conversation with people who have been in the business for decades, and they do concur with that sentiment. One of the biggest reasons we have had an absolute boom is with home prices appreciating at unprecedented numbers. This was due to the extremely low inventory and low interest rates, or cheap money, that we had, which created a bidding frenzy. And one of the biggest factors that you may or may not know about in that price appreciation was Wall Street hedge funds, private equity, and foreign investment syndicates. Up until that overnight mortgage rate hike that essentially doubled mortgage rates that happened back in June, hedgies were purchasing single-family residential homes up to $500,000 in cash, and they were paying higher than comparable sales at that time. This essentially set the market, and traditional buyers were competing against these types of buyers and these recorded sales. Wall Street company and firm Blackstone alone had $20 billion in a real estate fund, which drove this last boom. And that's just one Wall Street company. But guess what they just did? They just raised another $30 billion fund, and they're going to be holding on to that to create another crazy cycle once the dust begins to settle. Rates come back down, and they will take an even larger market share and turn those residential properties into residential rentals. Did you know that Wall Street now owns 25% of all apartment doors in the United States and 15% of all residential real estate? And that number might actually be higher right now. This has pushed first-time home buyers so that they are renters. Their goal is to monopolize the residential real estate industry. They want to eliminate the opportunity to build wealth and play residential real estate like a stock market. They want it to be up 20%, pump it up 20%, down 20%, pump it back up again, which they will do after this next price correction. The good news is we know what their plan is, and we can adapt to what they are doing. We can adapt to that accordingly because we know what their game plan is. So fast forward to about a month ago, and the hedgies with virtually unlimited amounts of funds, they changed their buying parameters to up to $400,000 purchase prices of single-family homes in Southern Nevada. As the rates went up, that $428 median price became unaffordable for most buyers. As an example, a $500,000 purchase price with 5% down at today's rates of 5.75%, with an estimated monthly payment of principal, interest, taxes, insurance, and private mortgage insurance is just north of $3,500 per month. For context, at a 3% interest rate, that payment is just north of $2,700, and that's a difference of about $800 per month on the same priced home. Same priced home, $800 a month difference. So with the hedge funds, they've been in price discovery mode lately. They've been changing their buying parameters, and with home sellers using those old sold homes as comparables when rates were much lower and affordable, this is causing massive price reductions across active listings. Almost 2,000 price reductions per week. Many homes are being reduced multiple times so we can find that threshold where buyers can afford. The month of June saw a slight decline in the median price after the record-setting month of May. The median price dropped about $2,000 in June to $480,000. Albeit very modest, we are waiting for the July numbers to come back out because we will be seeing a better trend of where the market is heading. Not to mention that the United States GDP has two consecutive quarters of negative growth, inverted yield curves, meaning the 2 year Treasury bond is now higher than the 10-year bond yield. And those are signs that we are currently in and have been in a recession. And it's my belief that things are going to get rocky for a little bit. But don't worry, there are some things you can do to prepare for this changing environment. Number one, if you've been thinking about selling your home, do not wait. I believe we will continue to see price reductions in the Las Vegas market and a lowering median price. It's my opinion that interest rates will continue to rise as the Fed is expected to hike rates another 75 basis points next week. We are at extremely high levels of home prices, and many homeowners, like yourself, are sitting on a ton of equity, which is the majority of wealth for most Americans. Now, homes are sitting on the market longer, and those days of multiple offers and home selling in a day or two are gone, where we have 10, 20, 30 offers. Those days are gone. We're moving back to a more normal market. We've had clients cash out and sit on the sidelines by renting maybe for 6 months or a year or two to see where things go. We've also had clients cash out and downsize or upsize, and they're using their proceeds from this high environment to buy down their rates. Number two, if you are considering buying, there are going to be many opportunities, much more opportunities than you have seen over the last couple of years since the pandemic. I am advising my clients to begin asking for concessions from sellers. These sellers are becoming more motivated to sell their properties, and they're learning that the greatest seller's market we have ever seen in history is over. They're learning this. So one strategy that can be used is called a seller buyback. And what it is I can help you negotiate several thousands or even tens of thousands of dollars for you to buy down your interest rate to make your payments more affordable and or use that for your closing costs. And to piggyback on that a bit, I want to explain something, okay? Experts are predicting a more normal appreciation of homes in the low to mid single digits. The average price appreciation of a home is between 3 and 5% per year, and they are expecting to see those levels return very quickly. Okay? If you are falling behind, and this is number three, if you are falling behind on your payments or know somebody who is struggling to meet ends meet, the good news is, unlike 2008, many homeowners now have much more skin in the game and equity. Okay, you can sell your home on the open market, and in most cases actually, be able to walk away with much more money than you could in a short sale or foreclosure sale. Okay, I would not recommend not paying your mortgage for a year or so and trying to quote unquote live for free like a lot of people did during the last 2008 debacle. Okay, but rather it'd be better for you to cash out that equity while it's there, so you can go ahead and get ahead financially. Keep in mind and remember, you only lose if you sell your property at a loss. You have to live somewhere, and if you stay in your home long term, historically, real estate has always appreciated over the long term. And I want to give an example of how purchasing a home at a higher price with lower rates results in lower payment versus purchasing at a lower price with higher rates, and why basing your decisions off a payment is always better than making decisions based on price. So I'm going to take the median home price of June in Southern Nevada of $480,000. The average homeowner who's financing their property, the average buyer, puts down 5% down, let's say conventional financing. And with the seller buyback that I've discussed in previous videos and as a strategy I'm recommending buyers to do now, let's say that you're able to buy down that rate to 3.5% at no cost to you. This results in a payment of approximately $2,783. That includes PITI and private mortgage insurance. Now, if you put down 20% or have 20% equity in your home, you can get rid of your private mortgage insurance either through a refi if you have the equity, or by putting down 20% on the initial purchase, which will save you $200 or $300 per month. But a lot of people don't have that. Most people are about 5% down. But let's take that same price of a home of $480,000, that June median, and let's say that there is a 10% price market correction, bringing the price of that median home down to $432,000, something we haven't seen in over a year. But with higher interest rates, I believe they will be steadily in the sixes soon. So let's say we have a 10% correction, and let's say rates are six and a quarter. Let's say they're six and a quarter when that median price, if it does come down 10% to 432. Let's say again your interest rate is six and a quarter. That payment is almost $3,200. That's a difference of $400 per month. If the prices do correct just 10%, which is half of what they appreciated in 2021 alone, sellers will not be offering large concessions because they're going to have lost a lot of their equity already. So you can see how purchasing at a higher price is a better result in terms of monthly payment. So if you plan on staying in the property for several years, that may be a better option for you. It's better to look at monthly payments long term versus price of the home. So there are a few options for you. If you are comfortable with where you're at in terms of payments and you are not looking to cash out your equity, that's great. That's excellent. Stay put, because I believe that there is going to be some opportunities on the horizon. So I recommend that you keep that credit clean, minimize debt, live a bit more frugally. I'm not saying don't enjoy life, but be more conscientious of your spending habits through this recession and look for some opportunities in the future. You're going to want to keep your powder dry because you will not miss out on these opportunities. You will not want to miss out on them. They're going to be there. You're going to want to take advantage of those, and I will help you do that. If you are looking to cash out your equity and sit on the sidelines, do not wait, because it's going to get very difficult very soon to sell properties at these levels. And if the prices and the price levels, they're already starting to decrease. The peak of this cycle was in May. Cannot get May numbers in July, and it's only going to get worse. So if you're looking to cash out and upsize or downsize, there are many more opportunities than there were just a couple months ago, and we can negotiate with the seller to buy down your interest rates because these homes are sitting on the market longer. People are starting to get concerned and worried because yes, they are up, but they're willing to pay for you to buy down that rate so you can have an affordable monthly payment. They would rather do that than do a price reduction because they will lose and they will not be able to give you the seller buyback. So I can help you negotiate that. But again, this is not a time to panic. Once inflation starts to come down, and that could be in months, that could be in a year, we don't know, but once inflation does start to come down, we will see rates start to come down. And if the market does correct and rates do come down where homes are much more affordable in terms of monthly payments, that will be the time to take advantage of the opportunities, and I will make sure that you are informed. Okay, because as we know, Blackstone has $30 billion that they just raised, that they are sitting on the sidelines because after this next correction comes, which I am predicting, in my opinion, is going to come because I start to see the data, I start to see it happening, they're going to come back in and they're going to do this again. So when that happens, that's when you're going to want to make some moves if you're sitting on the sidelines. Okay, I send out a Monday Market Pulse email to all of my clients and people who follow my work, so I hope you receive it. If you want to sign up for it, go to my Substack, type in your email, you will get it along with other articles, tons of important information, and that's at jordandove.substack.com. Again, jordandove.substack.com. And if I can be a help to you or anybody who might be in the market to make a move soon, please send me their contact information. Your referrals are greatly, greatly appreciated. If you have any questions for me, you can call me, you can text me, you can email me, whatever. Okay, I will do my very best to respond as promptly as possible. And if there is something I do not know, I will find somebody who can get that answer for you. Okay, so I hope you are doing well. Please take care. If there's anything I can do for you or your family, do not hesitate to ask. We are here to help people, okay? Lots of love. Until next time, be well.